Hey, if you're a stock and option trader and you've been watching the markets, then you know stocks have been going down a little bit over the last couple of weeks. Although we have had a nice move to the upside over this past week, I've been getting a lot of messages from people asking me, Lee, how do I play the downside? So all the stocks are dropping. I want to make some money on the downside. What are the best ways to do it? So in this video today, I'm going to show you a quick couple option strategies that you can use, simple ones that could help protect you on the downside or even help you speculate on the downside. If you think stocks are going to keep going down, here's a couple quick option strategies that could make some money on the downside. All right, so let's go. All right, what you'll see in front of you is the Smart Option Seller Guide to playing the downside. I am Lee Lowell, founder of Smart Option Seller. All we do is talk about option strategies. So today, as like I said, we're going to talk about some simple option trading strategies that could help make money on the downside. That's when stocks fall. So let's just quickly jump in. Shorter video today. Very simple, not complicated at all. Let's talk about it. So there are a few different ways that you can play the downside. And the first ones I'm going to tell you about are very, very risky, and ones that I don't do myself. So if you want to play the downside, if you think stocks are going to move down, here's how you do it. Now, the first one here on the list is you can sell shares of stock short, or you can sell naked call options. And let me tell you why these are extremely risky. And number one is because they have unlimited risk, okay? If you don't know what selling short stock means, is that without having any long position in a stock, you can sell stock short. You can take a bearish position in stocks that you don't even have. And you do that by borrowing stocks from your broker, selling them in the market, hoping that the stock price goes down, and then you can buy them back. If the stock gets cheaper, you buy them back for a cheaper price and you lock in your profit. Now, you don't have to have the shares long in your account first. You can just go in and sell shares short. It's called shorting the market. And you'll borrow the stocks from your broker. And if the stocks go down, you can make money. Now, this is where the unlimited risk comes from. So let's just say you sell these stocks short and all of a sudden the stocks start going up. You can have unlimited risk to the upside because the stocks could just keep going up as high as they can go. And if you're forced to buy those stocks back at a higher price than what you sold them for, you're going to lose money. So there's unlimited risk to the upside. So selling stocks short is extremely risky. Please, if you're going to do that strategy, be aware of the unlimited risk. Same thing with selling call options. If you sell naked call options, it's the same thing as shorting stock. When you sell a naked call option, you're expecting the price of the stock to go down. And if the stock price does go down, those call options that you sold will go down in option price as well. And then you can buy that option back at a cheaper price. The problem is if the stock goes up, that call option value is going to go up as well. So that can entail unlimited risk as well. So please be careful if you play those two strategies, shorting shares or selling naked calls. Very, very risky. So please be careful. Now, the next three choices that I'm going to show you, the couple other strategies, I should say, there's 4 others here. These are safer because there's not unlimited risk involved. Okay, so let's talk about what those are right here. The first choice is you can buy a put option, a single put option, or a number of put options, whatever you want to do. When you buy a put option contract, what you're doing is you're expecting the stock price to go down. And what happens is if you buy a put option, the put option price will go up. So that's what you're hoping to do. If you buy something, you want its price to go up. So you have to understand that as long as the stock price goes down, the put option value will go up. So if you buy that put option at, let's say, $1 a contract, and the stock drops, that put option value will go up to, say, $2 per contract, just as an example. So you bought it at $1 a contract, you can sell it at $2 a contract, and you can lock in $1 per contract gain, which is a $100 profit, okay? So if you're expecting a stock price to go down, number one, you can buy a single put option. Now let's just quickly go to our option chains here just so we can get a quick example of what we're talking about here. Now, this is an option chain. These are option chains from Interactive Brokers. It's a broker I use. If you want information about Interactive Brokers, read the description below this video. There's a link there for Interactive Brokers. Now, these are Apple put options. These are Apple options. What you see in front of you, call options on the left, put options on the right. So we're talking about buying put options. So if you're bearish on Apple and you think Apple is going to drop in price, what you can do is, like I said, buy a single put option contract. Now, this is where Apple closed on Friday, November 3rd, $176.66. Now, the price that you'll pay for these put options will all depend on which strike price you choose and which expiration date you've chosen, okay? So what we have up here is the November 10th, 2023 expiration, which is in 5 days from now. Now, the shorter the time frame to expiration, the cheaper the options will cost. But it also gives you less time for the stock to move in your favor. So you have to figure out what's your timing expectation here. How fast do you think the stock is going to fall? If you think the stock's going to fall very quickly, then you can buy these shorter dated options because you'll make money very quickly. Now, if you think, well, it may take a few months for Apple to reach my downside expectation, whatever that may be, then you may want to choose a longer expiration date, something like maybe December or January. Okay, so we're going to look at the difference in prices there. The two other things you have to consider is, I should say one other thing here is, which strike price do you want to choose? Now, there's a difference between, at the money, in the money, and out of the money strike prices. If you don't know what those means, I'll quickly explain here. An at the money strike price is a strike price that is very similar to where the current stock price is. So if Apple's around $176 and change, then you're looking at the 177 strike is considered at the money. That's the closest strike price to the current price of the stock. Now, an out of the money strike price is a strike price that's, for the put options, is listed well below the current price of the stock. So let's just say like a $160 put is roughly $16 and change below the current price of the stock. All these options will move differently compared to how the stock moves. And the way you figure that out is you look at the delta. Okay, delta is a very important, what's called a Greek. It's one of the Greeks. Delta is a very important Greek component of the option pricing. Okay. In a nutshell, deltas will tell you how the option price will react to a move in the stock price. Okay, we break it down in $1 increments. So an at-the-money strike price has got about a 50 delta. Now, deltas range from 0 to 100, 0% to 100%. And that tells you how much the option price will move to a corresponding move in the stock price. So an at-the-money option has a 50% delta, meaning if the stock price moves $1, the option price will move roughly 50% of that, or 50 cents per contract, $50 in actual value, okay? So the at-the-money options have about a roughly 50% delta. These out-of-the-money options have lower deltas. These 160 puts have roughly a 10%, 1% delta. 0.01 is 1%. Now, these 77.5 puts have a 59% delta, okay? So that means for these 77.5 puts, if Apple drops $1, your option price will move up about 59 cents per contract. If you chose these 160 puts, if Apple drops $1, these put options, these 160 put options will go up about a penny per contract, which is $1. So you have to choose. If the stock's going to fall, you want your option value to move as well. So choosing these out-of-the-money options, you're not going to get a lot of movement in that. Especially, you're going to get upset if the stock moves in your favor. You're thinking, yes, I'm going to make some money. Well, if you choose an out-of-the-money put, you're only going to get about $1 gain on it. Where these, at the monies, you'll make about $59. Now, there's also what's called in-the-money strike prices, where the put option strike is listed, above where the current price of the stock is. So you can choose, let's say, 190 put. Now that has about, a 99% delta. So that's going to move almost in lockstep with the move of the stock. But as you can probably see, these options cost, over $13 a contract. That's $1,300. The 177 puts cost about $240 to buy, and these 160 puts will cost you about, let these prices filter in here, about $8. Okay, so you're looking at an option. If you're going to buy this option, it's either going to cost you $8 or $240, or the 190 puts will cost you, $1,300. Let's wait for these prices to fill in here again. Over $1,300. So you have to decide, do I want to spend more money to get more movement? The higher the delta, the more the option price is going to react, but it's also going to cost you more. So you have to weigh out, what's more important to you? Is the cost more important to you? Or, do you want more movement out of your put option? It's all going to depend on, what you want to get out of the trade. Now, let's just say we go for these longer dated options. Let's go out to January. So any longer expiration is going to cost more money, regardless of whether you buy an at the money, out of the money, or in the money. So let's go to January. So these at the money options will either be, the 175 or 180 puts. We don't have the 177.5 listed. So these will be, close to, this has got a 41% delta. These 180s have a 55% delta. And here's what the option prices cost. $510 or, $735. And these in the money options, let's just say the 190 puts cost you, $1,400, and that has an 84% delta. So once again, the longer you go out in time, the more all the options will cost. And the deltas will be whatever they are. Now these 160 puts have a 15% delta this time. So that means if Apple drops $1, this put option will go up about 15 cents per contract, which is 15 actual dollars. Let's say the 170 puts has a 41% delta. So if Apple drops $1, this option contract will go up about 41 cents a contract, or $41 profit for you. Okay. So it all depends on what you want out of the trade. Now, I want to show you a quick, easy website here, free website that can show you, what these things look like graphically. This is a site called optioncreator.com, and it gives you a quick little rundown. Here's the strategies you can look at. And I'm going to show you some spreads soon, but here's the long put, and we're looking at a stock price of $100. This is just an example only. Okay, let me move myself here. So long put, got a stock price of 100, and let's just say you're gonna buy an at the money 100 strike put, and let's just say we got 90 days before expiration, and the premium is, we'll move this, make numbers easy, $5 a contract. Okay, that means it costs $500 for that put option contract. That's the most you can risk. That's the most you can lose, is $500. If Apple keeps going up, that put option value is going to go down and can expire worthless. The most you can lose is $500. So it's got a limited risk. And if you scroll down, here's the option chart. And it's got two lines here. Really, you want to concentrate on this line, the orange line, which shows you the value of the option at expiration in January, or 90 days from now, when that happens to be. So this is the chart. As the stock prices go down, which is what you want, the P&L curve starts to go up, which means you're going to start making more money as the stock price goes lower. And if the stock price goes up, you can see you'll lose the maximum, which is $500. You cannot lose more than that, no matter how high the stock goes. So that's the long put. Let's go back to our document here. Okay, so there you go. This better choice number one is buying single put options, whether you want to use at the money or in the money or even out of the money, depends on you. But it has limited risk. The risk is whatever you end up paying for the option. And if the stock price goes down, your option value goes up, you can sell it for a profit. The next thing you can do is buying a put option debit spread, which is basically you're buying a put option at one strike price, and you're going to sell another put option at a lower strike price. What does that do for you? Well, by selling the other put option, it's going to defray some of the cost of buying the first option. So it's a spread. So number one, you have limited risk to whatever the whole spread costs you, and it has limited reward. Okay, so we're going to look, let's go back to our website here and choose the bear put spread is what it's called. Okay, so once again, two options involved. You're buying one at a higher strike and you're selling one at a lower strike. It's called the spread. And the difference in those option prices is the amount that you will pay. Okay, so let's take an example here. Stock's at 100. Let's just say we bought the 100 put and we're going to sell the 95 put. Now this is what's called a $5 wide spread. It's the difference between the strike prices. 95 from 100 is $5. That's considered a $5 wide spread. And let's go change this to 90 days, both of them. And typically you're always going to choose the both strike prices in the same expiration. Okay. And let's just say this one's $5 and this one cost $3. So there's a $2 cost to the spread. You're going to you're going to pay $5 for the higher strike put, the 100 put, and you're going to collect $3 by selling the 95 put. So the difference between the is $2. $2 per spread, which is $200. Okay, that's the most that you have at risk is $200. And the way to find out what your total reward could be is that you take the width of the spread, which is $5. Okay, $5 in between here, minus out what you've paid for the spread, which is $2. So your maximum gain could be $3 per spread, or $300. So you got $200 at risk for a $300 potential reward. So we go down to the chart here, and this is your typical shape for a spread, an option spread. Now you can see as stock prices move down, your maximum gain could be $300. Your maximum loss is $200. So this is what the chart looks like for a bear put spread. It's called a bear put spread. You're buying the higher strike put, you're selling the lower strike put. The width in this case is $5. You're paying out $2 per spread. It's $200 for a reward of $300. The risk and the reward has to, add those up, has to equal the width of the spread. 200 risk, 300 reward, add those two together is $500. That's the width of the spread, okay? So if we go back to our cheat sheet here, which is right here. Now, so buying a put option debit spread. You buy a higher strike put and sell a lower strike put. Could be $1 wide, $5 wide, $10 wide, depends on what you want. And once again, you go out, you can check the expiration dates. It all depends on what your time frame is for how fast you think the stock is going to fall. Okay, so let's look at another strategy here, and this is selling call option credit spreads. It's basically the inverse of buying put spreads, but now you're selling call spreads. Okay, so what you're going to do is you're going to sell a lower strike call option and you're going to buy a higher strike call option. That way you won't have any unlimited risk, because I told you if you sell a naked call option, you have unlimited risk. So in the spread, you're going to sell a call option, but you're going to buy another call option. You're going to buy a secondary call option to cover yourself. In case the stock does go up to higher, you're protected. Okay, so let's go back to our website here, and we're going to pick the we want to do a short. We're going to sell a call. So this is a bull call spread. What we want to do is actually, it's called a bear call spread. We want to sell it. So once again, stock's at 100. In this case, we're going to sell. We're going to sell the 100 strike call, which is the lower strike, and we're going to buy the higher strike call. Once again, we'll use 90 days here. Choose the same expiration, and we're going to sell this one for 5, and we're going to buy this one for 2. Now, in this case, you're selling the spread for $300 or 3 points. You're selling the lower strike 100 call for 5, and you're buying protection, the 110. Actually, let's make this the 105. Sorry, this is a $5 wide spread. Okay, so you're collecting $5 and you're paying $2 to cover yourself. So the net is $300 in potential gains, or potential risk, I should say. Okay, if you're selling something, that's your risk. So you have $300 at risk to potentially make. That's what you can make is $300. Right, you sell it for 5, buy it for 2. That's your maximum gain is $300. And here is the curve. It looks just like the put spread. If the stock prices go down, which is what you want, your maximum gain is $300. Your maximum potential loss is $200. Okay, so once again, you can look at this here. You're making 3. You're risking 2 to make 3. Okay, so and how do you lose on this trade? How do you lose for any trade? If you're taking a bearish position, you're going to lose if the stock goes up. Okay, if the stock goes above both strike prices in this case, you're going to lose the maximum, which is the $200. Once again, they have to add up to the width of the spread. This is $5 wide. You're getting $3 as your potential profit, and you're risking 2. Those add up to 5. Okay, look at the chart. Potential gain is 300. Potential loss is 200, and that happens if the stock goes up above both strike prices. Okay, so in this case, if the stock moves above $105, you're going to have the maximum loss. You want the stock to remain below the 100 strike price. Okay, as long as the stock stays below the short strike, you're going to make the maximum. Okay, so it depends on where the stock ends up. If the stock ends up in between, let's say at $102 at expiration, you're going to have a varying level of profit or loss depending on, what you originally sold the spread for. Okay, so let's go back to our document here. And the last thing that you can do to take advantage of the downside is to sell covered calls against any long stock position that you have in your account. I've made some other videos about selling covered calls. So if you have 100 shares of stock in your account, you can sell one single call option contract. What does that do for you? Well, number one, it's going to bring in money to your account. When you sell something, it gives you money. So if you sell a call option at a certain strike price, you're going to get whatever that strike price is going for. So you can make some money. And if the stock goes down, you'll lose money on your stock position, but you'll make money on the call option, because the call option value will go down and you can buy it back for a cheaper price, or you can just let it expire worthless. All right. So it all depends on what you want to do. The same thing with the call spread, like the put spreads. You can sell $1 wide call spreads, $5 wide call spreads, $10 wide, whatever you want to do. And you have to make sure that the stock goes down. If the stock goes up, you're going to have a losing position, but your risk is always capped. Okay. So if you think stocks are going down, you can buy put options, you can buy put spreads, or you can sell bear call spreads or sell covered calls. Okay. So that in a nutshell is things you can do. Take advantage of options trading strategies for the downside. All right. So if you think this has been helpful, give me a thumbs up, leave me a comment, give me a like, send me an email. I will always answer. I'll put some other videos on the screen here that you can look at. Some other, if you want to watch some other videos that we make. Once again, down in the description below the video, I have some links in there for some resources that will help you. And once again, the website that we've been looking at today is optioncreator.com. All right, that's all for me today. Hope everyone has a great trading week ahead. This is Lee Lowell signing off.